Do you find it challenging to make consistent profits in the forex market with trading indicators?
No, God!
Well, you are not alone. In today's video, we are going to delve deep into the world of technical trading, uncovering why indicator-based trading often falls short and revealing an alternative approach that could change your trading game forever. So if you are ready to transform your trading strategy and unlock the secret of trading indicators, keep watching. For those of you who are new to trading, indicators are technical analysis tools that traders use to analyze market trends, identify potential trading opportunities, and make more informed trading decisions. There are many different types of indicators, including moving average, relative strength index, MACD, and many more. These indicators are designed to help traders identify trends, momentum, and potential market reversals. While indicators can be helpful for traders, there is a lot of debate in the trading community about whether they are worth using. First, let's discuss the pros of using trading indicators. One of the biggest advantages of using indicators is that they can help traders identify potential trading opportunities. Let's take for example, as you can see, we have here a live chart of Euro USD. The market has been in a bit of a roller coaster recently, but there is something interesting happening right now. Let's zoom in on the moving average. Here we have two moving average. The blue line represents the 50-day moving average and the orange line represents the 200-day moving average. These are widely used to identify trends and potential trend reversals. Now take a look at this point right here. See how the blue 50-day moving average has crossed above the orange 200-day moving average. This is what we call a bullish crossover. This event is significant because it often signals a potential uptrend in the market. It suggests that in the short term, the price is moving higher at a faster rate than in the long term. It's like a signal from the market saying, hey, there might be some bullish momentum building up. Now, imagine you are a trader who relies on this signal. You might decide to enter a long position, expecting the price to continue rising based on this bullish crossover. But here is where it gets interesting. As you can see, shortly after the crossover, the price did start moving up, confirming the initial signal. Traders who entered a long position at the crossover point might have been feeling pretty good.
Yes!
Another advantage of using indicators is that they can help traders stay disciplined and avoid emotional trading decisions. Many traders struggle with their emotions when trading, and indicators can help take some of the guesswork out of trading decisions. Additionally, many trading platforms offer built-in indicators that are easy to use and can be customized to meet the needs of individual traders. While there are many advantages to using trading indicators, there are also some downsides to consider. One of the biggest disadvantages of using indicators is that they can be lagging and may not always provide accurate information. By the time an indicator flashes a buy or sell signal, the market might have already moved significantly. Indicators are based on historical price data and may not always be able to predict future market movement accurately. As a result, traders may experience false signals which can lead to losses. Let's look at a real-life example. Imagine we are looking at the Euro USD daily chart with the MACD indicator. The MACD has two moving average, a faster one and a slower one. The key signal is when these two moving average cross. Let's say the Euro USD has been falling for some time, then the price starts to turn around and trade higher. As a result, the MACD moving average begins to rise as well. Eventually, the faster moving average on the MACD crosses above the slower moving average. This crosses signals a buy trade for traders who follow the MACD strategy. After this crossover, the market indeed moves higher. However, a price action trader who focuses on actual price movement might have entered the trade even earlier. Both the price action trader and the MACD trader would have made profits, but the price action trader would have entered sooner and used a tighter stop loss. This tighter stop loss means they risk less money. While both traders could have exited at the same price, the price action trader captures more profits due to the closer placement of the stop loss. It is important to know that the MACD and other indicators lag, meaning they react to past price movement. This lag is one of the main concerns with indicators. They can't always catch the market's precise turning points. This is where price action trading shines. Price action trading strategies are based on the current price of the market. This allows price action traders to spot turning points in the market as they occur, often offering earlier entry points. Check out this video where I showcase a powerful approach where I seamlessly integrated MACD, support and resistance levels, moving average and price action. This combination is a game changer for anyone looking to improve their trading entries and make more informed decisions in the market. Don't miss out, check it out. Another disadvantage of using indicators is that they can be complex and difficult to understand. Some indicators require a deep understanding of technical analysis and can be challenging for new traders to master. Now that we have discussed the pros and cons of using trading indicators, how can you determine whether they are right for you? The answer depends on your trading style, experience, and goals. If you are a new trader or have limited experience with technical analysis, indicators can be a helpful starting point for analyzing the market. However, it is essential to remember that indicators are not foolproof and should not be relied on exclusively. If you are an experienced trader, you may have developed your trading strategies and may not need to rely on indicators as much. It is crucial to remember that indicators should be used in conjunction with other forms of analysis such as price action and fundamental analysis. Ultimately, whether or not you use trading indicators is a personal choice. Some traders swear by them while others prefer to rely on other forms of analysis. The key is to find what works best for you and your trading style. We hope this video has been informative, and if you enjoyed it, please give it a thumbs up and subscribe to our channel for more trading tips and insights. Thank you for watching.